Hello, everyone. If you are a beginner investor and if you want to avoid costly mistakes, I recommend that you stay tuned until the end of this video. Hello, everyone. Welcome to Bartelle's Money Talk. I'm Johnny, and today we have a special guest. He is a CPA, Mr. Michael Matthew. Michael, can you please introduce yourself? Give us a little background about yourself.
Thanks for having me here, Johnny.
Yes, you're welcome.
As you said, my name is Michael Matthew, and I live in the Toronto area in Canada. I focus on real estate investors and other companies involved in real estate. So as an example, one of my clients is a home builder. I'm the CFO for that company, and started out by going to real estate seminars in the US, trying to figure out where I fit into the whole real estate picture. And what I realized after going to a few of these conferences and talking to some people, that one of their biggest areas of concern was dealing with the income taxes. They didn't want to do it. They did it badly. They didn't do it at all. And none of that is good. So I, as a CPA, deal with taxes all the time and figured this is where I could really contribute most, is by helping them with that so they could focus on whatever type of real estate investing they're doing themselves. I do own my own rental property close to my home here in the Toronto area. And my next project is actually, I'm looking for a multifamily in likely Texas.
Nice. So Mark, now I know they have a saying about you. They say, now let me get this right here. They say you're the accountant and the real in real estate. So could you talk a little bit about that? Because I think that was pretty interesting saying about yourself.
I like to keep things very practical, and I also don't like to complicate my clients' lives any more than is absolutely necessary. I've seen several clients were set up by someone else and they had really great structures, except not for them. They were never asked as to how many properties they're going to acquire, as to how many properties they were going to manage, and they just frankly paid for things they didn't need. And so I try to keep things real by only giving you what you need, what you'll use, because that's how you're going to be able to succeed in this business, is by not giving yourself too much overhead unnecessarily, by not making it so complicated you can't figure out what you're doing from one week to the next. And that is basically the approach I have.
Nice, nice. So one of the things that I'm very interested in is if you are a first-time property investor, if you want to try to get into property real estate investing, right, and you're doing it for the first time, could you talk about some of the costly mistakes that you need to try to avoid if you're a first-time real estate investor?
A lot of ways it comes to doing things wrong property, wrong partners working with, and things like that. So I had a client that in a competitive bidding situation waived right to a property inspection. Don't do that. Don't do that. Some $30,000 later of mold remediation, she was able to start renting it out. And frankly, I don't think she's going to live long enough to make that up, especially considering she has all her other costs, like you would have normally, property taxes, maintenance, interest, and she's still got to overcome this backlog. Plus, it's in a rent control situation. So it's not like she can put up the rent by 25% a year just to catch up. So don't do that. And also the wrong partner. People will often join a real estate club, which is a great way to do it. You get to meet like-minded individuals, get exposed to accountants, attorneys, real estate brokers, all of which will be very helpful to you. But the mistake this person made was joining up in a business venture with two of the fellow club members without screening them. And it got really nasty. I saw some of the emails going back and forth. They literally hate each other. And years after the property was sold, they're engaged in litigation. Not good way to do things. And also wrong location. You have to start by looking for a landlord-friendly jurisdiction. In Ontario, if you want to kick a tenant out for non-payment of rent, it can take up to a year just to get a hearing. You're going to succeed because they didn't pay the rent. But even then, it can take another 2 months for them to get formally kicked out, because where we are, even the police legally can't evict a tenant for non-payment of rent.
Whoa.
The only officer who can do that is the sheriff, and there's not a lot of them, and they got a lot of people in front front of you, so it takes time. I was on a call with a real estate investor from Texas, and she apologized that it took 3 weeks to start eviction proceedings for non-payment of rent. I'm saying 3 weeks is pretty good. Where I'm coming from, 3 weeks is really good, you know, and
Compared to you? Yeah, I would say so.
they're out in a month or two. Yeah, that's okay. That's the number one rule for real estate investing, frankly, is you have to go to a landlord-friendly jurisdiction because it doesn't matter anything else. If you get a bad tenant in there, they often call them professional tenants that know all the rules and use them against you. As I said, you can go a year or more without any rent. Meanwhile, the bank doesn't care. You still have to make those mortgage payments. In fact, you have no income, that's your problem.
As long as you make the mortgage payment. Wow.
Yeah, otherwise they'll eventually foreclose, right? So
right. So you said something that I want you to kind of explain. Rent control. Could you explain that a little bit?
rent control is obviously not something that it applies in every jurisdiction, but in most of Canada it does apply. And the government will set a guideline rate. I think it's generally quite low, somewhere in the neighborhood of 1.5% to 3%. And that's the maximum rental increase you can do with the same tenant. If a tenant moves out and you have a new tenant, then you can charge whatever you can get. But once the tenant's in and they look to renew their lease, you're limited to that 1.5% to 3% per year, unless you have an exceptional thing, like, you know, maybe you had to put in a new roof or some major expense, then you can apply for a variance. Nothing major like that happens. You can't go above that guideline, which is one of the main reasons why I'm not looking to invest in further real estate here. Because unless you had a tenant turnover where you could always keep coming back to the market rates, I mean, you could have people in there for a decade or more. Meanwhile, the rates around them could have tripled, and you're still putting it up that small amount each year.
So really, in sense, you're losing money.
Oh,
Because you
yeah.
can't.
Because you got insurance that goes up every year. You may have HOA fees, so you have repair costs certainly, and those don't go down. Property
Wow.
taxes always go up. So
Have you faced anything like that? Now I know you do cross borders. I mean, I know you have some real estate in Canada, and also know you do some investing in the U.S. as well. Do you
yeah,
experience the same thing in the U.S. as you do in Canada when it comes to real estate investing?
there are significant differences. That's one of them, is
Okay.
that many places don't have rent control. Basically, as I said, you look for the landlord-friendly states, and while you can invest in any state and can get a good deal, you have to have a good tenant, you know, one that pays their bills on time. And my first two tenants were a dream. I own a condo, and there's not that much maintenance. All the heavy lifting is done by the condo corporation itself. But then I had someone move in that had a lot of friends over. These friends were called cockroaches. And it took months and many sprays get rid of them, and finally got rid of them by having the tenant move out.
Wow.
So that is not something that you want to go through, right? And part of the risk of being a landlord.
Right.
You need to screen your tenants, and that's something that particularly the beginner investors may not think to do, is you have to get confirmation of their employment. You have to make sure they have their own insurance policy for their contents. You want to get a reference from their previous landlord. A very good way that I've learned to find out how they'll treat your place is you have some form that they need to sign, and you just drop by their place unannounced to have them sign this one last form. And then you'll see how they live. You'll see how they treat someone else's property. That can save you a lot of headache.
Wow, that's a good way to do it. Okay, all right, I like that because at least you'll see before they try to take over your place. You're like, oh, maybe this ain't a great deal after all,
Exactly.
because that could cost you more money in the long run.
Oh, absolutely. And another good tip, once they're in, is you write into the lease agreement that you're going to replace the batteries on the smoke detectors, you know, twice a year, or even better, 4 times a year. So they know you're coming in. They know you're going to see how they're living in your place. And if that's a problem for them, they won't commit and they won't sign the lease.
Nice. So those are some great things to make sure you do to try to avoid those costly mistakes.
That's right.
Wow. So, and I didn't mention this earlier, but I know you wrote a book. Could
That's
you
right.
talk about that, your book too? Because I know you wrote one.
Yeah. It's right here. It's called A to Zen Real Estate, Peace of Mind Strategies for the Canadian Investor. And my goal with that was not just to focus on taxes, although there is a chapter or two on taxes. My goal was to address as many of the areas that beginner investors are curious about so that they get over that fear and are able to move forward with an investment. So I cover where to invest, how to invest, what type of investment you can make. You can do anything from the single family residence that people are used to, or a small duplex, but there's all kinds of options, different ways of doing it. I know, for instance, in Canada, there is a concept called fractional investment or fractional ownership. You can literally start your investment career for $1. Now, you won't own a house, but you'll be able to participate in the gains that are available in the housing market without having to come up with the whole amount yourself. So, as I said, I'm in the Toronto area. It's the second most expensive area in the country to buy a house. The average house in US dollars is over $1.2 million. That's pretty expensive. You have to get, as an investor, a 20% down payment. So that's $240,000 just to be able to buy it yourself. And that's a lot of money for many, many people. Also a reason I am looking at the States. I was looking at investing in Ohio, 5 houses, and the asking price for the 5 houses combined was $230,000.
Whoa, that's a pretty good deal.
In Toronto, it would have been over $5.5 million.
Wow, so I can understand why you're looking to this in the States over here to invest. I mean, if you can get 5 houses for that amount, then wow, that's pretty great deal compared to where you are.
And that's
Wow.
one thing that people often think, especially beginner investors, I have to invest in my own backyard. No, you don't. People say, well, how am I going to manage the property? You're not going to. And that's a good thing. You don't want that work. If the only way you can make a real estate investment pay is by doing all the work yourself, it's not a great investment. The margins are too thin. So basically, even if it is in your own backyard, you should price in a property manager when you're evaluating, is this a good deal for me or not?
Another good tip. Okay. Well, Michael, so tell me, if you are, again, you new property, new investor trying to start in the property, trying to get into the property real estate investing game, how should an investor get set up to invest in real estate?
If you're a U.S. resident, the easiest thing to do is to set up an LLC, which will take title to the property. And what that does is it allows you to have the liability protection of a corporation, so that if there's a problem, someone slips and falls, for instance, breaks their arm, they're going to sue the LLC. They're not going to sue you. You don't want them to sue you, because then all your assets are at risk. Your house, your car, any other investments you have, all that is available. Any other companies that you own, all those are available. So by limiting it to the LLC, protected yourself. Because the LLC is set up as a disregarded or flow-through entity, the income and expenses from your rental business will flow through to your personal tax return. That's the end of it. If you're Canadian, you can't do that. You need intervening corporations, just because of the way our tax authorities look at the LLC. They don't consider it to be a flow-through entity. And so if a Canadian resident owns an LLC and owns a rental property, it will result in double taxation.
Wow.
Yeah, that's a no bueno, as we say. As a Canadian resident, typically what I do is I have them set up a Canadian corporation, which owns a Wyoming C Corp, and then set up an LLC in the state of investment. So Florida is a pretty popular state to invest in, especially for Canadians that are from the eastern part of the country. So they would set up their the Canadian corporation owns a Wyoming C Corp, which owns the LLC in Florida. And so then we can use the LLC as a flow-through entity because it flows through to the Wyoming C Corp. And then everything's in the US, so everything is a domestic corporation, and then the C Corp files the taxes.
Okay. So is it easy to set up an LLC for first-time real estate investors? Is this it's a long process? Can you talk a little bit about that?
There's slight variations from state to state, but typically it does not take a lot of time. I work with American CPAs who set up the LLCs and the C Corps in any state that you want, and it usually takes a week or so. What can take some time is when you have a corporation, you need to have a tax ID number for it. That, not surprisingly, is issued by the IRS. And the IRS schedule is whatever they feel like. So You can have it incorporated in a week or so, and you could wait. I know I've had a client that waited up over 2 months to get the EIN from the IRS, and there's not much you can do about it.
You just have to wait.
You just have to wait. The sooner you get started, the sooner you'll get it. That's the only advice I can give you on that one.
So, and I know you said it was a little bit different in Canada when it comes to the LLC.
That's
So
right.
is it anything that you have to go through and set up what in Canada? Or it's just you have to go, how did you do that in Canada? I mean, because I know about the LLC in the States, but how about going to that means in Canada?
That part is the same. It's
Okay,
just that you can't own it directly. So
got
you
it.
set a Canadian corporation at the top of the stack, and then you have these two other corporations, the Wyoming C Corp and LLC in whatever state you're working in. I say
Got it.
Wyoming C Corp, that's the most popular state for C Corps for real estate investors. Delaware, some people talk about, but that's more for larger companies, companies that are going to go
Mhm.
public. They have a setup that makes that much easier. But Wyoming,
Okay.
the fees are reasonable. Everything is automated, so it works pretty quickly. For instance, I had to get a certificate of good standing for a Wyoming corporation. I'd never done it before.
Mm.
And I went in today to get that. The whole thing was done in less than 5 minutes, and it was free.
Free is good.
Free is good. Well, they're easy to work with. They have good asset protection. They have good privacy. So Wyoming is probably the #1 state for setting up for real estate investors right now.
Okay.
And the
All
only
right.
the only complication is, as a Canadian resident, you need that extra Canadian corporation and you need the C Corp. The LLC work is all the same.
Okay. All right. Thank you for that. So I know again that you do cross-border investing in real estate. What are some of the secrets to like unlock cross-border real estate investing? If you want to hop over to the US and you want to go maybe to Canada, what are some of those secrets that you can share?
Regardless of which direction you're investing from, don't try to reinvent the wheel. Work with people that other people have worked with. So let's say you're like me, you're looking to invest in Texas, but you don't know anyone that's invested in Texas. So what you do is you join an investor group, deals with the geographic area you're interested in. So Texas, or maybe even more subdivided to Dallas, Fort Worth, Houston, or whatever. And you ask, okay, who's a investor-friendly real estate agent to work with? And you'll get some recommendations. And if 2 or 3 people mention the same person or company, it's probably a good lead for you, and you should check that out. And once you have one recommended person, good people know good people, right? So they'll know, say, a property manager, and the property manager will know a contractor to come in and do all your repairs that the property manager can't do. And so by having 1 or 2 key referrals, you can get the rest of your network built out. You don't want to have to put together a team from scratch, not knowing anybody. It takes too much time, too much effort, and at the end of it, they could not be a good person to work with. I had a client purchased properties about 10, 12 hours away from where they lived in Toronto area. And their property manager told them, a tenant moved out and I haven't been able to find anybody. Oh, okay. Keep looking, place an ad, whatever. And this went on for months. No tenant, no tenant. So they got sick of this. They wanted to see what's going on. So they drove up there to see what was going on. Much to their surprise, there was a tenant in their property. And they said, oh, well, maybe they just moved in. When did you move in? 6 months ago. So what happened is this property manager rented out the property to the new tenant, put all the cash in his pocket, and told the owner, sorry, didn't find a tenant for you.
Whoa. So what happened? What happened in that situation?
Obviously, you fire the property manager, but good luck trying to get the money. The point
Wow.
is, they did not get a proper recommendation for someone in that area.
So that is very key to make sure you connected with the right.
That's right.
Wow.
And you want to succeed in this business, you want to get some knowledge, you want to get some coaching or mentoring, and you need to take action. I've seen people that take action with no coaching or knowledge, and they end up doing things like overstructuring, as I mentioned earlier. And
Right.
other people, I just have to go to one more seminar, I just have to read one more book, and they end up taking no action whatsoever. They've got all these courses and all these books, but no real estate.
Nothing to show for it.
Nothing to
They have
show
the
for it.
knowledge, but nothing to show for it. Right.
You need something in all those areas: knowledge, coaching or mentoring, and action.
Okay. All right. And I got this question here because it's kind of a burning question because I know when you first kind of starting out in real estate, and you're trying to, learn the different things that you're doing, make sure you don't make mistakes. Can you talk a little bit about taxes when you're dealing with real estate? With the new investor and they go get their first property, and doing everything. property, is there some taxes that they should be looking out for? How does that work?
There's some basic principles that apply to any deduction you claim in your taxes, and that applies equally here in real estate business. And that is, you have to get receipts and you have to keep them. You can't just go by a credit card statement or bank account statement for your debit card. You have to keep the actual receipts or invoices, what have you. You also need to know that when it comes to property taxes, many states have a homestead rule, which means if you live in the property that you own, your property taxes are significantly lower than if it was an investment property. And that can catch investors by surprise because they'll do their due diligence. They'll say, all right, send me your last 3 years of property tax bills, and they get them and everything checks out. But they don't ask the question, and they don't find out, is there a homestead rate for your property taxes? And only to find out that when they get their property tax bill, it's significantly higher. The other thing is you need to report things on a timely basis. You need to do a proper description of the expenses. Probably the trickiest area deals with what's a repair versus what's a renovation, because repairs are typically written off in the year. Renovations are written off over time through the depreciation. It can get quite tricky. Simply painting the wall, for example, that's considered a repair because it's routine and you're just restoring to the condition it was before. But if you upgrade it, like I did when I ripped out the carpet full of cockroaches and put in laminate flooring, well, that's considered a renovation that's depreciated over time, not an immediate write-off.
Okay, that's good. That's good information to know. So
you need to make sure that you have a professional CPA looking at your returns, because many CPAs, I get new clients every year, and so the first thing we always ask for is where's your last year's return? So this client brought in her last year's return, and I go to the rental schedule and there's no interest deduction, especially in Toronto area where the mortgages are so big. Mortgage interest deduction is huge. It's by far the biggest expense on your rental schedule. So the only way you don't have a rental interest expense is if you own the property outright. So I asked her, do you own this property outright? I'm not sure. What do you mean? Do you have a mortgage? She said, oh yeah, I have a mortgage. So where is the interest expense deduction? She went to one of these tax preparer places that get as much as 8 hours of tax training, and they never asked, and so she never volunteered that number. And I just stared at her. It's like, okay.
Wow. Wow. So she missed all of that.
Yeah, she paid way too much tax. And this is not a controversial deduction, right? It's, you get an annual mortgage statement, the figure's right there. You got the perfect backup if the tax authority asks to see it. She didn't know about it, so she didn't ask. And that's one of the things I included in my book, was a list of common real estate expenses, because I started learning about accounting when I was 16. And so I'm a bit older than that now, you might have guessed. And I just assume, well, you know what you can write off, right? Maybe you don't know how the depreciation works because that's a little bit more complicated, but you know the basic categories. Many people don't. Important not to miss on the basic fees that you can deduct. So, for instance, it's common to have mortgage insurance. Well, that's deductible over the term. In Canada, mostly people have 5-year terms or less. So you can deduct whatever that insurance is over the 5 years, or if there's a financing fee that's involved, that's also deductible over those same 5 years. And a lot of investors miss that one.
Michael, this right here, I think this is gonna wrap it up here. Can you leave the audience with 3 golden nuggets that you would tell someone when it came to a real estate investor in their beginning stage? To cap it off, 3 nuggets.
3 nuggets, okay. Don't go it alone. That's for sure. There's so many people out there that can give you good information that can get you off to a proper start, because there's nothing more discouraging than getting yourself into a problem simply out of ignorance, and it can sour you on the whole thing. My personal tip is only invest in real estate that's actually been built.
Okay.
Unless you're a builder. That's the only exception. If you're not building it yourself, there's so much that can go wrong. As I said, I work for a home builder. During the pandemic, price of lumber quadrupled. And The only way you can get a construction loan is if you pre-sold the property. And guess what that means? You've already set the price. By law, you cannot change that price. So you just have to eat that. We always allow a margin when we're doing our pricing of a house, but we don't anticipate quadrupling of our input prices.
That's so, yeah.
I'd say the last thing is, as a CPA, I suppose this is a natural one. You have to go by the numbers. You're not living in this place most of the time. You don't have to love every little detail about it. This is not an emotional exercise. This is a numbers exercise. You get yourself a spreadsheet, a Google sheet, whatever, and you run the numbers. This is the anticipated rent based on the market rents, which is easily available. These are the costs. You'll have the previous or the current owner's costs because that's part of the information you'll ask from him. You'll build in a contingency. Tenant moves out. You're not necessarily going to replace them the next day. So maybe you have only 10 months of income or 11 months of income in a particular year. And what's your return? And whatever your return is, your minimum return, you better see that number or you move on. Where people get into trouble, this is more common with places they're going to live in, of course, is they get into a bidding war because I just have to have that property. That's not how you do real estate investing. That's how you end up tying up way too much money in a property that you're going to regret after.
Michael, thank you for those nuggets. And I really hope the listeners take heed to what Michael has just shared to avoid those common pitfalls or mistakes. So you can, and they could be really costly if you don't avoid them. So thank you, Michael, for those, for all this great content. And audience, if you like the content, please like, share, and subscribe. And Michael, one more thing. Could you please, anybody wanted to reach you, could you provide your information?
Sure. The best way to get a hold of me is by email. My email is Michael, Michael, askmichael.ca. So Michael at askmichael.ca.
And listen, I would tell you, you can ask any question you want and come into real estate, taxes, whatever the case may be, Michael?
Yes, because beyond the tax work, which is naturally what I do, I've taken, I don't know how many 100 hours of real estate education myself. So if I don't know the answer, I can usually get it from one of my contacts fairly quickly.
Again, thank you, Michael, for your time on Bartelle Money Talk. And until next time, you have a great evening. And thank you for sharing your time on our show.
Thank you.
Whoa.